Welcome to PhillipCapital's Weekly Market Watch. This week, we have with us Mr. James Chua, investment analyst from PhillipCapital Management, who will share with us his sentiments moving into the new year. So James, as we wind down to a close in 2008, do you see markets recovering in 2009?
I think our base case scenario is to say that at the end of 2009, markets will be higher than at the end of 2008. We base this view upon the premise that U.S. earnings will bottom sometime in the third quarter, fourth quarter next year. In terms of percentages, the market achieved its EPS high in 2007. And then, we're heading towards the end of 2008 right now, and we're starting to see that actual reported earnings have come in 35% lower year on year. Our base case scenario is assuming that 2009 earnings will drop only 5%, totaling a total of about 40% drop from the 2007 peak. So assuming that earnings doesn't drop more than 40%, and where the S&P is right now is actually below 45%. So the market price is actually pretty efficient in pricing in how much earnings have declined. Then we would say that based on that premise, the markets will bottom sometime during 2009, and at the end of 2009 you'll see it higher than where it is today.
What are the key risk factors in 2009 for economic recovery?
Yeah, I think the number one key risk in markets it will be the recovery and the condition of the credit markets. What we're starting to see in terms of price action in the markets is, over the last 10 days or so, the equity markets have been rallying, and you haven't seen that same kind of recovery in terms of the credit markets. Actually, the equity where the equity markets are right now is actually pricing in a much more optimistic scenario versus what the credit markets are pricing in. Credit markets are pricing in 13-14% default rates on corporations, and that's an incredibly high number, because you'd have to go back to 1933 to see those kind of default rates. Even in the 2000 and 2001 scenario, where it was mostly internet companies that defaulted, total default rate was only 9-10%. So we'd say that it's a necessary condition for credit markets to recover in order for equities to recover. And the second key risk that we see in 2009 is, of course, the ability for earnings to bottom during the second half. If it turns out that the credit markets don't recover, and it turns out that home prices continue to drop, then there is a realistic case scenario that earnings of U.S. corporations will continue to be revised downwards. So those are the two key risks. In conclusion, we'd say we want to watch closely at the condition of credit markets, and number two, we'd want to watch for the bottoming in U.S. earnings.
What are your views on recent rallies in markets?
Yeah, I think I was surprised to see how quickly several commentators called the market bottom as the market rallied off the lows. It's been about a week and a half. We would say that the market rally is inconclusive. There's a lot of things out there that the market still needs to contend with. At least to me, it is not entirely clear that a recovery is in place. There are a lot of uncertainties out there. Actually, in terms of the rate of EPS revisions downwards, we're actually continuing to see an acceleration to the downside in EPS revisions. So we would look at the recent rally with a skeptical eye. We wouldn't be surprised if the market puts in a new low going forward. And in general, we still take a wait and see position.
Thank you, James, for your time. That's all we have for you today, so tune in next week for more market updates.